Welcome everyone to our ninth AVE, coming to you by from Acres. Today we'll be talking real estate, anything with real estate. Very excited with our panel with Derek Varona, Ignacio DuQuesne, and Mariano Mallol. So today, Derek Varona will be moderating. So I'd like to start with a prayer, as we always do, and then hand it over to Derek. So in the name of the Father, and the Son, and the Holy Spirit, amen. I'd like to pray for our Belen community, especially for the Perotti family. Anthony Perotti lost his battle a few days ago, and he just showed us so much in his fight and brought so many of us together. And want to pray for him and his family, and may he rest in peace. I'd like to pray for everybody that's going through hardships with COVID and anything else, and hope for the their betterment, and give thanks to the Lord for all the blessings that we have as well, and for being able to do what we're doing here and offering this to our community, and we're lucky to have these guys with us tonight. So in Jesus' name we pray, amen. In the name of the Father, the Son, and Holy Spirit, amen. So I'd like to hand over the hosting duties now to Derek Varona, class of 03. He's going to say a little bit about himself and then introduce the actual panelists. Like I said, we're very excited about this. So without further ado, Derek, you're on, and good luck.
All right. Well, thank you, Carlos. I appreciate it. I want to start by thanking everyone for being here. And Carlos, also thank you to you for helping kind of put this together, and all the huge strides we're seeing with the Alumni Association, and Be Connected, and really growing the Belen alumni community to, the reputation it already has as being a monster out there here in Miami. So a little bit about myself. I'm class of 2003. I have a real estate brokerage that I run with another Belen alumni, Rick Mariano, and been doing that for about a little over 8 years now. And it's been a good time. But what I've also been doing is I've been helping the Alumni Association chair the Acres subsection, which is a professional network community for those of you that don't know. And it's the architecture, construction, real estate, and engineering section. So what we've been doing the past few years is putting on some events to kind of get those professionals together to network and grow that community. We've had events like hard hat tours at Coco Walk, and happy hours all over the city. So I'm going to just kind of jump right into introducing Ignacio DuQuesne, and Mariano Mallol, who are also class of 2003, who work in real estate and finance, and I think they're going to have a lot of good insights on some of the topics and be able to answer some good questions that you guys might have a little later on. So Mariano, he's the managing director at Goldman Sachs, head of specialty finance and investment banking. Iggy, he's a director at the Estates Investments Group, which is a local kind of developer over here. And Mariano, if it's all right with you, I'm going to give you the floor to really kind of talk about how you've gotten to where you're at, what you kind of do on a day-to-day basis, and some comments in general on real estate, and then we'll lead into some topics after both those discussions.
Yeah, so like Derek said, Ignacio DuQuesne, class of 2003. The way I started was I went to the University of Pennsylvania and the business school there, the Wharton School. Afterwards, I moved to New York City, where I ended up working there for 7 years, doing actually what Mariano does now in investment banking, covering the global industrials and healthcare sectors. Worked there for a number of years at two of the bulge bracket banks in New York City. And afterwards, I had the opportunity to go to the buy side. And that's when I started in real estate private equity when I was still in New York City, during my 7 years in New York City. So I joined one platform that acquired hotel assets across the US, and also in South America, Central America, and the Caribbean. And we also had a platform to acquire private schools, so Montessori branded and privately branded schools across the country. So I had the opportunity to launch those types of real estate private equity platforms. After being in New York for 7 years, my wife and I moved back to Miami. She also, I met her at Wharton as well, and she had been in New York, actually working at Mariano's company, Goldman Sachs as well. And and we ended up moving back to Miami. And since I've been back in Miami, I've also been doing real estate private equity over the last 6 years. As Derek mentioned, I've been at the Estate Investments Group, and I currently serve as their Director of Investment Management at the company. And it's actually the four partners of the company, two out of the four partners and myself are also Belen graduates. And what we do is we're a multifamily developer in South Florida. We currently have a portfolio of approximately 1,200 units across multiple South Florida markets, Broward, Miami-Dade County. That portfolio, we also have a pipeline of an additional 1,500 units that we're in the process of developing, that we already own the land, and that we've started construction, or that we're going to be starting construction imminently. So it's a pretty sizable portfolio that we have right now, and I can get more into the details afterwards in terms of what I've seen across the last 6 years and the market down here and generally across the United States, because we focus on national and local trends. But yeah, with that, that's currently what I'm doing. And with that, I'll pass it over to Mariano so he can introduce his portion.
Yeah, thanks. I did this from the office to not get interrupted by anybody at home. And of course, the first thing that happens is somebody comes into my office. So sorry about that. So my background is not all that dissimilar from Iggy's. So went to Vanderbilt, always with an interest in real estate and finance and all of those kinds of things, just having grown up in Miami around a lot of that myself. And, I made a decision to go up to New York for what I thought was going to be a couple of years in investment banking, and then I'd move back down and do something in real estate. And, when I made a decision to join Barclays at the time, there were a couple of places where I could do, something related to real estate within investment banking. And that was in the real estate group, which is a very obvious and kind of commercial oriented group, or the financial institutions group. And so I had a relationship with a few people in what's referred to as FIG. And there was just a broader, set of available, pockets of financial institutions to learn about. And so I ended up going that route. And what like I said, I thought was going to be a couple years of learning in investment banking turned out to be the middle of the financial crisis, where we learned a ton, and it was a tremendous, period of time within the financial system, just generally speaking. And it, aside from just having to hold on to my job, it also hooked me in, within the kind of the realm of investment banking. And so about 6 years ago, I moved over from Goldman from Barclays to Goldman. And today I spend all of my time covering non-bank finance companies. So everything related to the real estate world, from the largest participants like Fannie and Freddie down to little tiny mortgage companies that we're working on taking public, really like right now. And then broader than that, in today's world, there's a tremendous amount of focus on, how does technology aid the real estate sector, consumer lending, banks themselves. And so I spend a lot of my time in the financial technology and tech-enabled lending spaces.
Great. Well, thank you for those intro, guys. It's pretty insightful on your path on how you guys got there. I know that one of the more interesting conversations that a lot of people want to touch on, so I'm just going to dive right into it, is I know that there was a recent Fed meeting just yesterday kind of discussing interest rates. Would love to get your thoughts, Mariano, on how that meeting went. A couple of the comments of, interest rates staying low, the economy struggling, even with the vaccine starting to roll out, and just kind of get some thoughts there. What you see in the short term and in the long run.
Sure. I'll start, and Iggy should add to this. So, I think that the house view around here, at least, is that the Fed is going to take an extraordinarily accommodative view on rates, and quite frankly, also from a fiscal perspective, you're going to see what we expect to be about $1 trillion of stimulus come through the system, with some risk that it's higher than that. It's just a question of when and how the government does it. But if you think about, what we think about rates the Fed is expected to be very, very accommodative for quite some time here, multiple years. So 2023, 2024 is sort of the earliest that we would expect the Fed to raise rates. That doesn't mean that, if you think about it from a real estate perspective, that doesn't mean that, interest rates and mortgage rates won't go up over time. In fact, right now the 10-year's at, call it 1%, and we think it can go to 1.5% by the end of this year, which, I think the market has generally been wrong about that for, multiple years. But I think right now the Fed is very focused on getting the economy back up and running. And the linchpin to that is how quickly vaccines take hold and people start going out and spending, in their communities. And until you see that, everybody's going to really, keep on the gas. The one thing that I would add to that is, Derek, you mentioned the economy is kind of suffering. And I think certainly on a spot basis, it's very tricky. But, when you look at the stock market, it's really telling you, and I think what investors are seeing is that the amount of policy that's going to go into stimulus in the economy is going to outlast COVID by a long shot. And so that's why you see, economists forecasting 6% growth this year, 4% next year, because of all of that stimulus that you're seeing from the Fed.
Interesting. Iggy, you have any comments?
Oh yeah, I mean, I'm in agreement, and that's we rely on a lot of the Goldman research on those types of points, and we follow it. So I mean, we expect very similar trajectory of interest rates, as Mariano noted. Staying very low through the 2024. And Mariano, it seems like that's come down a little bit because, I had read last year at some point that some people were expecting it to go as far as 2025, remaining low, but I guess it's come back a little bit in terms of when they think they'll start raising rates again. And I think what Mariano said regarding, because a lot of people I have conversations with all the time think it's completely correlated in terms of where mortgages are priced and the interest rates that you get on commercial real estate or residential homes. And that's a great point, that it's not entirely tied one to the other. So that's I think that was a great point to mention on that front. In terms of the liquidity in the market, there's an incredible amount of equity and debt capital in the markets, that are pursuing real estate transactions, both on the residential and the commercial side, on a national basis and on a global basis, really. A lot of private equity capital, a lot of institutional type family office capital as well. That's been sitting on the sidelines through last year and through this year, and also as Mariano noted, there's a substantial amount of liquidity that's also being injected by the Fed and by the government into the economy, which is causing those projections in the growth rate. So, I think that liquidity is going to be there to do deals, large ones or small ones, and we can get a little bit, later on in the agenda, we can speak a little more to that. But I think it's a very interesting time to be doing real estate investments from that perspective.
No, yeah, I mean, I agree, and I think with all the stimulus and all this money and all the equity, I think today's market is very different from, let's say, 2008, right before the crash there. And a lot of people are talking about, bubbles now, especially with the GameStop thing that's going on right now and all the cash out there. From a bubble perspective and real estate, can you kind of describe a little bit of the differences and how maybe we might be protected from something that happened in 2008 versus where we're at now, and what maybe some of those risks with all this money being injected and interest rates so low, that you kind of comment on that?
Mariano, you want to comment on that first from the financial institution side? Given 2008, what happened there, and
yeah,
you lived through it on Wall Street, and you saw what happened.
I think a few things. The system is, and whatever, those are always famous last words, but the system is so much safer than it was then, right? If you think about like just residential real estate and residential mortgages, 97% of the market is agency or government. And those institutions themselves are now, backstopped by the federal government. And so, the residential real estate world where you had, kind of pre-financial crisis, subprime mortgage brokers, with a huge swath of the market, that doesn't exist today. The non-agency market is either very, very, very high quality jumbos, which is safe and on bank balance sheets, or or a very, very small slice of what's referred to as non-QM, which is effectively just non-Fannie, Freddie, or Ginnie mortgages. And then you have a banking, a banking environment that has a tremendous amount more capital. And so I don't worry so much about asset bubbles related to residential real estate for sure. Commercial real estate, if you look at, kind of the trends, you have a bit of a tale of two cities. You have places like where I'm sitting right now in New York that are very, very, very challenged from a vacancy standpoint, with not a lot of visibility in terms of what's going to happen on the back of this. Are people actually going to go back to their seats in major cities in big, tall towers? Unclear. But you have actually, Atlanta, Miami, a lot of anything in Arizona where commercial real estate's actually doing reasonably well and in a pretty safe manner. So I don't worry so much about asset bubbles related to real estate. I mean, I worry about a lot of the nonsense that's going on with GameStop and Robinhood and other things like that. But I think that feels to me like a blip, and it'll sort itself out reasonably quickly. But you do have a lot of stimulus that is in the market. And as Iggy mentioned, I think, right now, the way that commercial real estate, multifamily, residential real estate is being financed is pretty safe.
Yeah.
And Iggy, just to jump in there before you start, because Mariano mentioned, obviously, New York having vacancy issues, and with Andrew Cuomo being Florida's best realtor right now, how much are you guys accounting for that in your multifamily development down here in South Florida? I'm seeing it personally on the brokerage side with people moving from California and New York down here, desperate for anything, buying short-term rentals, just trying to get in here is super difficult.
Yeah, I like I mentioned at the beginning in the introduction, I lived in New York as well for 7 years, and I love New York City, and yeah, I have a lot of friends that stayed working there, like Mariano, a close friend that stayed working in New York City, and a lot of my colleagues and my classmates also stayed there in the city, and a lot of people have been moving down. I can't even count the amount of people that have moved down from New York to Miami. In the last half a year, and it really is it's done great things for the real estate market, particularly from the residential side. Derek, I'm sure you've seen it in the increases in the valuations and the demand, just the sheer demand. Prior to this whole thing occurring, there was a concern. There was a real concern that the condo market down here was being oversaturated with units, and now there's a tremendous amount of demand. So I think to Mariano's point, one thing that I think is different than 2008 is that there's not as much systemic risk in the system, where the largest banking institutions are going to go under and it's going to bring the entire market down with it. But there are different pockets of distress, particularly if we're looking at it from a real estate angle, like different geographies, like Mariano noted, like places with a lot of vacancy. There's particular sectors like retail and hospitality that have the distress rates in those sectors have skyrocketed. Actually, at our company, we acquired one hotel in Hialeah that we're converting to a multifamily building, and that we're very excited about that deal. And that was a distressed hotel that was owned by a REIT that they didn't have anybody traveling to their hotel in their portfolio. So, there's a lot of retail. Retail was also struggling at even prior to COVID. Retail, brick and mortar retail, was struggling because of Amazon, the Amazon effect, and technology, and now with remote work and everybody ordering all their groceries and their food on Uber Eats, and brick and mortar has continued to suffer, and we see similar distress rates in retail as well. And we actually, again, to give you a personal example, we acquired a distressed Target site which we've now re-entitled, and we're now going to be building 501 units on multifamily units in Broward County. So we've seen these pockets of distress, but in terms of Miami in general, it's just been incredible. Like the population influx from New York, from South America, from Central America, from Europe. Miami is like, it's becoming like the city of the future. And I think remote work and technology and Zoom, what we're on right now, it's really enabling all of that. So I think that those are my different thoughts on that sort of question.
Yeah, and because you mentioned condos, and obviously you're in the multifamily space, something that I've kind of been curious in, and it's a conversation I have a lot of times with buyers down here, kind of domestic buyers too, that are looking to invest in Miami. Miami, I feel like in the past has been a very strong condo city where you have the developers like Related going out there and selling internationally, and all those things. But it just has felt lately that it's really trending. You're seeing a lot more Class A multifamily buildings, which I feel traditionally hasn't really been Miami's like MO. And obviously you're on the front line on that. Maybe you can kind of get into that, at least something that I'm sensing, that Miami was a very strong condo city, and now for kind of residents trending a little bit more towards multifamily. If you can comment a little bit on that, Iggy.
Yeah, I think there's a couple factors that play into that. I think one factor is that affordability is a real issue across the entire country. So one thing that, Derek, I'm sure you've known, and we've actually spoken about in the past, is that there's a lot of these funds. It's not only the fact that people want to move from the major city centers and with their families to have a nice yard and a house, and move out of the, to be able to raise their family in the suburbs. But we've also, we've seen that in terms of the multifamily demand down here, where the affordability has been a real issue, because these private equity funds are buying these homes, and then people are buying homes as well. And then if you're just thinking about Miami, people are moving here, like I mentioned, and that's increasing the prices further. I think I've seen some submarkets in the last year that the prices have increased by 100%, and the sales have increased by, the sale volumes have increased by 100% in some of these markets. And I think, Derek, you can probably comment on that. In terms of multifamily, there is a lot more Class A developments. People still like to live in very nice condos, but there's a lot more demand for those by the high net worth individuals that are moving to Miami to be able to fill that demand for those high priced condos. And then people are sort of priced out of the homes because they're, the median price of these single family homes has gotten so high that, that's why we're building Class A multifamily product at the estate companies, where we bring down the absolute rent per unit. We have smaller unit sizes, and we bring down the absolute rent, so that the average unit in our building will be priced at, $1,700, $1,800 a unit, where if you bought a house, it would be substantially higher than that, with all the expenses that come with the house. Even though there's a lot of benefits with, as everybody knows, with buying houses too, with the tax write-offs and the like. But I think that's why there's been a lot of multifamily down here. It's the population trends, it's the amount of liquidity, the fact that interest rates and bank rates on savings accounts are so low. People are looking for other places to find yield. So investing in multifamily provides those high returns on their investment. And yeah, that's sort of my thoughts on why there's like more demand and more building of multifamily in South Florida.
So Mariano, and I'm just kind of drawing on a little bit of my experience over the last 10 years in real estate. When it comes to these big financial institutions that own a ton of real estate, I'm thinking of like Invitation Homes, for example, right now, where back in like, 2012, we were brokering deals to them, and they were buying. I mean, we brokered just a few deals. Obviously, we're a small brokerage, but they're telling us they're closing on 300 homes a month in just South Florida alone. And, so they have to have a massive inventory down here. I'm just curious what those REITs are thinking long-term. How is that going to affect maybe like the homeowner here when something happens and, you have such a concentration of single family home ownership by these REITs. And we know that it's here in Miami, but it seems pretty quiet because they're not selling those assets. At least it's not obvious to me that they're selling in mass amounts yet.
Yeah, but they have to be feeling pretty good about things, right? Because they made a big bet on suburban living, effectively, right? If you think about the kind of things that they own, and as we've been talking about the sort of the exodus from the city, at least at a minimum temporarily, if not structurally, should benefit those portfolios. And I think their whole pitch, right, to the communities and to the financial markets is really that they're able to maintain those homes at scale, right, in the sense that they'll own a variety of homes in a neighborhood, and so be able to do maintenance on them in a pretty systematic and low cost and scalable manner. And so, if anything, I think there will be further consolidation amongst the smaller versions of imitation homes to get to further scale. But they've done well, right? That seems to be a permanent part of like the ecosystem. If you think about like the markets that financed the real estate assets, like the market that financed invitation homes and the single family rental market did not exist 10 years ago, like at all, period. And today it's one of the deeper, very liquid, very stable markets, because it's kind of consolidated from a bunch of folks that owned 40, 50, 100 homes above the kind of the single family, the 1 to 4 cap, to now these massive organizations that are run like machines. And so I don't think it'll change. I'm not sure I can speak to really why they haven't sold in one geography or the other, but I do think that there's a few things that have been brought into the market, whether it's that or Zillow Instant Offer or things like that I think for the most part will remain a permanent part of the ecosystem.
Okay, thanks. Yeah, and we'll wrap up the discussion here a little bit. Maybe you guys, just to bring it back home a little bit, maybe make a few comments on why Florida is, where you see it in like the next few years and why it's so great, but not too long. And then we'll open it up to some questions and answers to the community here. And maybe also just throw in a couple, how Belen, the community, has kind of helped you in your career. I know Iggy, obviously some of the partners there are all Belen alumni, and how you can see how this community can help. We can all help each other kind of grow in our professionally and personally.
Yeah, sure. I'll start it off there. So, as Derek mentioned, it's 4 partners at our company. Myself, obviously, and 2 of the main partners are also Belen graduates. And I think one thing we're always looking to do is, meet new people. We're constantly in meetings. We're a vertically integrated company in terms of we have a shell company and a general contractor. So we control the development and the building of all of our projects throughout South Florida. So we manage all the different trades in terms of how the buildings are actually constructed. So I know there's a lot of different people on this call at different organizations in different areas, and happy to get in contact with anybody after this meeting and answer any questions, or provide references and connect on ways to partner together. We also manage all the developments from the financing side, which is really my area. As the director of investment management, we raise all the equity and the debt capital for our transactions as well. So it would be great to meet fellow alumni that work at different banks. We work with a lot of local banks in Miami and national banks as well. So, I think that's one way that we could all, partner together and do things going forward.
Yeah. And I look forward to organizing kind of more events for us to kind of all get together and see how we can share things. Mariano, I don't know if you want to just say a couple things and then we'll open it up to some questions here.
Yeah, I mean, I kind of stumbled into finance like totally clueless and kind of just got lucky along the way. And part of that luck was having points of connectivity with, people from Belen, people from Miami, people from Vanderbilt, that kind of helped point me in the right direction here and there, particularly in like a turbulent time during the financial crisis. And so, I've tried to prioritize particularly now that Be Connected is out there, and it's a lot easier to really react to people that need, a hand here and there, or just don't know what, kind of the world of, whether it's investment banking or what have you in New York, like, and so I would just, because it seems like this is going to get posted to, like, I would just encourage people to reach out through that network. And I've made an effort to, pay it back over the years, because the number of mistakes that, you just don't know you're making when you're in college or the early years of your finance career is pretty breathtaking when you kind of look back on it. And so anything that we all can do to help people out from the Belen, community, like I'm encouraged by it.
All right, thank you. So Iggy, one question that I think someone's interested in is, how do you see construction costs kind of looking forward?
Yeah, definitely. So I've been at this multifamily developer for 6 years now. So I think I've seen it through construction costs through a very interesting period. I will say one thing. In our projects, since we're a vertically integrated company and we have all these different divisions to manage our projects, we do bring in deals at a lot lower basis than other developers that go to third-party general contractors and the like, because there's additional margins in there, and a lot of developers have to bond their projects, so that increases costs further. But I have seen the perspective where, over the last 6 years, construction costs have been increasing a good amount, in particularly in the South Florida markets. And that goes with inflation, because of the demand that we spoke to a few minutes ago for these types of projects in South Florida. And, because people have started to see cap rates have been coming down, and people have been acquiring more of these buildings. So there's been additional demand for these types of projects. And that leads to more demand for the actual workforce that's involved in putting up these projects. So that's led to the construction costs increasing as well. So, that's sort of what I've seen, but, like everything in life, it's up and down. And, I'm sure there's going to be a period where that's going to start decreasing as well. Not necessarily to the point where it was, in 2008, 2009, 2010, but, we'll likely see, construction costs come down a little bit more. And then, as that demand starts to increase again, then, vice versa, so on and so forth. So.
All right. I've got another question here, Mariano. Someone's curious, how do the investment bankers make money? Can you walk through a quick example of taking a bank or some sort of real estate asset public, and what does that look like from the Goldman Sachs side? Sure.
So I guess so banking is a very, very broad term, but in my world, the two main areas is M&A advisory and capital markets transactions. So capital markets transactions could be go raise a piece of debt for somebody, so like a leveraged finance bond, or you could take a company public. Right now, we're working on 2 IPOs actually in the mortgage space for just mortgage originators. And the way that you get paid is you go out and you market the story, and you go find investors, and you go on the IPO roadshow. And ultimately, when it's come down to the day of pricing, let's say that they raise a $200 million IPO, the investment banking kind of syndicate, because everything's done with multiple banks these days, gets a certain percentage of the proceeds that are raised. And that's generically speaking true for most any capital markets transaction. It's a lot like if you think about, Derek, in your business, you get a certain percentage of the value of the home that you sell. It's kind of the same idea. And then in the merger world, what you're doing is you're serving as a trusted advisor to companies when they are, they want to go sell the company and monetize their life's work, or they're looking to go buy a company and bolt it on. And that's a little bit, kind of more bespoke in the sense that it's, either some dollar amount or a percentage of the deal, similarly to capital markets deals.
So what are your thoughts when a company IPOs and it doubles in price the next day?
So it's a good question. Like the sweet spot, right? Like if like what you're trying to achieve, because at the end of the day, the set of investors that buys into an IPO is taking more risk than if they just bought Apple's stock, right? Like a large liquid public company. So it's a new company, it's unproven, and so typically you want to see something like a 10 to 15 to 20% rise on the first day or days, first month of trading. When it doubles in its price the first day, it either one of two things happened. Either the banks just got it totally wrong, right? And we misjudged the value of the business and sold it too cheap. And that happens. Or the kind of either retail driven demand or sentiment, like not unlike what's going on in a topical thing like GameStop, where people just pile into a trade and find some momentum, that happens too.
All right, that's great. See if there's any more questions here. Carlos, I don't know if you want to jump in with any questions. Feel free.
Right now, we don't have we don't have any additional questions from the chat. But wait. We just may have one just came through right now. Hold on. Oh, here we go. Oh, all right. It's not a question. But do you guys have anything you want to finish off with, or?
No, not really. I just want to thank everyone for being here. Just encourage everybody to continue being involved in the Belen Alumni Association. Reach out to any of us with any questions. I know, Carlos, we're going to Beyond Belen is coming up soon, which is a mentoring program that for any alumni out there, I don't know if you want to touch on that, and then maybe we can close the.
Yeah, well, I appreciate the opportunity for the plug. So a couple of things. First of all, I want to thank these guys, and just want to read a message that's been sent from Crescencio Ruiz, which is the president of the Alumni Board of Directors. I want to thank you, gentlemen, for taking time to share your knowledge of the industry with all of your Belen brothers. Your Alumni Board of Directors is committed to providing you with greater resources in the near future so we can have more events such as these. So thank you, Chris, for the comment and those words. Because in case you guys didn't see the chat, that's why I wanted to read it to you guys. Derek, like I said, I want to thank all three of you. The fact that the class of 2003, you represent the younger generation. For us, it's very important to have this engagement with you guys and share your knowledge and see your growth. I mean, for crying out loud, I saw you guys. I was with you when you were seniors, and I remember those days. So it's an honor and very special to see you guys be where you are right now and share with us where you are right now and what you're doing. So thank you for that. So as you were saying, we do have the Beyond Belen mentorship program that we emailed a bunch of alumni, and we are looking for mentors in the business and finance industry. Especially, we need a few of you guys. So Ignacio, Derek, and Mariano, I'm hoping you guys sign up for that, and I'm looking forward to connecting you guys with the seniors. It's a great thing to let them know who our Alumni Association is, let them know how powerful it is and how important it is to, after they graduate, that, hey, this continues. So that's why, hence the name Beyond Belen is there. So that is coming. Also, thank you for the plugs for Be Connected. That's such a great tool that we have now. Mariano, thank you for mentioning that and the way that you've been using it. And I encourage everybody that's on this AVE that's an alumnus and is not on to please go on there and see the value that it has, and it's constantly growing, and we're constantly working on it. I have a tremendous group of guys that helped start it up and helped it put together and just maintain it. It's just a great group, and that's the board helping us out with that. And these guys are just maniacs, and they're very devoted to the school and love the school very much. So thank you all for this. Ladies and gentlemen, this will be recorded and placed on our YouTube channel. So if you have any questions, anything you want answered, we will have also contact information for these gentlemen as well. If you need to ask us, just email us at alumni@belenjesuit.org and we'll get you that information. and that's it. Anything else I'm missing, Derek? You think?
I think that's
You
it.
see how he and I took it very seriously and wore sport jackets, but Derek didn't. That was,
Yeah. Oh, really? In front of all these people, you're gonna call Derek
I'm-
out like that? Nice.
yeah. Yeah, well, you said it's gonna be on YouTube, so I figured that it was the right thing to do.
Yeah.
Yeah. Well, listen. Thank you all for dressing up for the occasion. I'll keep it simple like that. You guys look great. All
Thank
right.
you for thanks for organizing, Derek.
Thank
All
you,
right,
Derek.
thank you guys. I appreciate it. Good night, everyone, and thanks for joining.
Yeah. And by the way, I forgot to mention, look out for our next topic, February 18th, on cryptocurrency. Looking forward to that one. February 18th. You should see that in the advertised starting next week, so we can get people signed up. That's a fascinating topic as well. Looking forward to that. And that will be sponsored by SAFE. That's our accounting group and our finance group. So looking forward to that, February 18th. Okay. Anyways, good night. Thank you all, and we'll see you. All right.
Everyone.
Thanks.
Ta-ta.
Thank
Yeah.
Bye-bye.
Good night, guys.